Get to our next guest. He says the debt crisis in Europe is what has been sending U.S. stocks lower. With me now is Michael Aronstein. He's the CEO of Marketfield Asset Management, where he oversees more than $1 billion. His Marketfield fund, by the way, beating 91% of his peers last year. Great to have you back.
Thanks for having me.
So you're listening to Europe. I mean, they're not even close to what they need to be doing, is it?
No, they're sort of flopping around like beach dolphins at this point, and I guess that's what they'd like to be, is on the beach.
What are they waiting for at this point, Mike?
Crisis. I think the history shows that they don't act until forced to by panic and so much pressure for markets that there's really no course of action other than to do what the markets demand. Right now, they're battling the imperatives of a free market system. They don't like what the bond market's saying about sovereign debt. They don't like what's going on in credit default swaps. They don't like what's going on with stock trading. They don't like short selling. So they're trying to manipulate all of these things more to a political aim, and that's not possible.
What do you think, Michael, they need to do? I mean, you heard over the weekend Giulio Tremonti calling for Euro bonds, but out of Italy, of course, you'd expect him to be calling for that.
Matt, I think the ECB needs to reflate. They really need to go in there and purchase a lot of this paper and not sterilize the transactions, and allow their balance sheet to increase to the same degree that the Fed did. In the 15 or so months since the crisis in Greece broke out last year, the ECB has actually contracted its balance sheet, which I believe accounts for the timing of this particular crisis in sovereign finance. That whether or not they intend to, they've been quite tight on a liquidity provision basis.
But you think the Eurobond issue is not one that should be raised right now, because surely Angela Merkel is going to have problems selling that to voters next month.
Yeah, I think we've talked about this for more than a year. I think the German population is going to be pretty skeptical about using its credit and its standing in the world to support the habits of politicians around the periphery.
Mike, you anticipate that we're going to continue to see market volatility until Europe gets their house in order?
Yeah, I think this reminds me of pretty much every crisis I've seen for the last
We've kind of been here before, haven't we? Just
33 years. I remember when Argentina dissolved their currency board, I think right up till 2 days beforehand, they kept getting on television and professing that we will never delink the peso and the dollar. We will never do that. There's no chance. And then 2 days later, they did it, and they didn't even apologize. They just said, well, the exigencies of arithmetic have forced us to do this.
Mike, I want to go to what Adam started talking about, and that was financials. A lot of big names selling. You guys have been short financials. Yeah,
we have been for a long time. I just don't see, forgetting the ultimate mortgage liabilities and the clawbacks, I think going forward, the industry is going to have a very, very difficult time making any money. And I think they have a cost structure that really has been calibrated for boom times, not for retrenchment or restructuring. And I think the returns on equity are going to be very, very disappointing for a long period of time, whether or not they have any further balance sheet impairment.
So even when folks say, hey, check out the valuations of some of these financials, they're so low, who cares at this point because of what the outlook is for these guys going
I think
forward?
The valuations are based on a history that is receding farther and farther into the distance.
Speaking of history, we've been looking at U.S. history over the last couple of weeks because of that downgrade. We actually talked to Warren Buffett, got some comments. He actually spoke to Charlie Rose last night about the U.S. debt rating downgrade, which he had said in the past is worth a quadruple A rating. Listen up, everyone.
We can print money, so we don't have to worry so much about our government becoming dysfunctional as we have to worry about that damn printing press becoming dysfunctional for some reason.
In fact, you were saying that the United States can always pay its bills, and therefore it should not have had its AAA rating downgraded.
Yeah, that's correct.
Yeah.
So, Mike, should we be comforted by the idea that the U.S. can always print money so we don't have to worry that we can always pay our debts? Or does that worry you when you hear it from everyone?
Clearly, when you borrow in your own currency and you have a central bank that has basically unlimited ability to create money, you don't have any credit risk. You have all kinds of other risks, but
so the downgrade ridiculous in your view?
Yeah, and I think S&P is a business in search of a mission, and you know, they're trying to get their names in the newspaper, I suppose, to remain even slightly relevant, but they have a pretty outstanding record as a contrary indicator.